Hello, everyone. Welcome to Feedstuffs 365. I'm Sarah Muirhead. Joining us today to talk about what's happening in the beef sector is Trey Freeman with Ever.Ag. Welcome, Trey. Great to have you back with us.
Good to be here again, Sarah.
For those of you that are tuning in, we thank you for your time as well. And if you have any questions, feel free to post those there in the chat area on the right-hand side of your screen. If you're joining us from social media, you can post those directly in your social channel. So Trey, you've got some slides for us today. Let's go ahead and put those up and go ahead and take it away.
You bet. So last week, Packers purchased 99,000 head on the cash market. That's a new high for the year. 29,000 of those were bought with time, replenishing their inventory to a level not seen in a long while. Looking at the 5-area weekly average steer price, came out at about 220 for the week last week. Now, so far through this week, however, we've already traded $2 higher in the south from last week at 220. And in the north this morning, they started trading 225 to 228 live. That's 3 to 6 higher from last week. Live cattle futures made new contract highs earlier this week. Took a small breather yesterday and then made another round of new highs today. Overall, just tight supplies of fed cattle are driving this market as cattle feeders continue to feed longer with no incentive to discontinue. The nearby June contract is about $6 under cash. So if you look at the 5-area average or the five-year average of Kansas basis there, it's about $6.50 to the positive. So it's about in line with that. Near contracts and live cattle continue to hold a premium to further out contracts. This is characteristic of a bull market, but it is making it hard to work in a positive margin for cattle going out in the late part of this year, given current feeder cattle prices. Feeder cattle. Here's the CME feeder index, slowly edging higher over the last 5 weeks, bouncing around 293 the last few days here. Again, nothing new. Tight supplies are driving the market with new contract highs today, and August feeders making history. August and September finally breaking that $300 level and closing above it. Looking at managed money and live cattle, managed money increased their net long position nearly 7,000 contracts week over week. The latest report reflects their positions as of Tuesday, April 29. If you look at open interest has increased significantly. I'm catching up with my slides here. Open interest suggests managed money has added more to their net long position since then. It's increased almost 26,000 contracts from when those most recent managed money positions reflect. So overall, same story over and over. New record highs with occasional headline ripping gains away, but overall cattle markets ultimately rebound, climbing the wall of concern, as they say. Looking at weekly fed cattle dressed weights. Fed cattle dressed weights are averaging 916 pounds year to date, up 25 pounds from a year ago. Year-to-date slaughter, year-to-date fed slaughter through 16 weeks, it's 46,000 head lower, about 0.5% lower, but with heavier weights, production is up 2.8%. Cow slaughter. So if you look at the non-fed side, particularly cows, which makes up over 90% of that, slaughter is sharply lower. This isn't really a sign of herd rebuilding. We just simply don't have the cows to kill after the liquidation we've seen over the last few years. So now if you look at total slaughter versus total production, so this is fed and non-fed, we've killed about 300,000 head less so far this year through 16 weeks. And average dressed cattle weights have averaged 875 pounds opposed to 841 pounds last year. So 34 pounds heavier on average year to date. Those weights have offset the smaller slaughter, leading to total beef production year to date greater than last year by just a hair, by about 50 million pounds, or about 0.7%. So really the heavier weights have added over 300,000 head to the total cattle slaughter year to date. You can see recently here. So the information I just showed, that was official slaughter data, which only goes up to April 19th. Only estimates have been released for the last couple of weeks, so those were not included. But so the last 2 weeks total slaughter was estimated at 555,000 head and 559,000 head. And this week, analysts are estimating slaughter to be around 565,000 head. If you combine all three of these weekly slaughter estimates together, that is 172,000 head less than the same 3-week period a year ago. That's a massive crank back and kill by the packer. So why the lower slaughter? Well, packers, they're on the ropes. The cattle feeder has all the leverage here on the cash market. That 5 area has shot up over $13 a hundredweight in just the last 3 weeks, and cash is even higher so far this week. Boxed beef, if you look at cutout prices, it's not moving higher at the price at the pace that they're having to pay for the animal. So effectively, packers are trying to regain some control over their margins because they are and have been taking a beating for a while now. This week is another good example. Cash moving $2 higher in the south, up to $6 higher in the north. Boxed beef has ground higher this week, but not to the extent to where packer margins can make headway. And that is with 3 sharply lower weekly slaughter counts recently, too. So not record low for those weeks, but very near it if you don't include the 2020 from the COVID saga. Now, we talked about the sharply lower cow kill earlier. That's where 90s trim is derived and what's pushing it to astronomical prices. But a little softness here recently, not that significant, not too much to be concerned about. But it is rare to kind of see softness like this in the early part of spring. So we'll continue to monitor this through the next couple of weeks. 50s. 50s lean trim is mixed with 90s to make your hamburger meat. Basically, it comes from fed cattle. With the sharply lower fed cattle slaughter the last few weeks, though, you would think 50s would show a little more strength than it has. So a little thought-provoking here, maybe some slight concern. You would just think that the reduced fed slaughter would give it some juice, but that's another one that'll be monitored here the next couple of weeks pretty closely. And briefly, I'm going to run through some charts of the middle meats and ends just to show you the strength of some of the primals as of recent. So the rib primal averaging about $29 per hundredweight more year to date. That's about 10% higher. If you look at the loin primal's averaging $26 higher year to date, or about 7%. And chuck is averaging 8% higher prices year to date. So really, this is phenomenal. And finally, the round averaging around 14% higher year to date. Now, you do have to take into account that these have been propped up or driven higher with lower slaughter estimated for all but 2 weeks this year, but higher is higher. Now, meat retail prices. Let's look at all fresh beef retail compared to pork and broiler retail prices. Consumers continue to pay up for beef. We don't have the data for the month of April yet, but for March, the all fresh beef retail price was reported at $8.42 per pound. That's up 54 cents a pound from a year ago and up 27 cents in just the last few months. That's whereas pork and chicken has basically been flat for a number of years now. So that beef to pork ratio comes up here and there. You know, I don't know how much that's worth following anymore. They just don't really pay attention to each other. I would guess that's just partly the increased quality of beef over the years relative to pork, and also there's so many cuts of beef compared to pork. It's just attractive in that sense too. Now, concerns for beef demand moving forward. I saw an article on a survey by Lending Tree last month. This isn't the chart for that. I'll get it. But that survey showed that 25% of buy now, pay later users are funding grocery purchases. This was up 14% since a year ago. and 41% of those surveyed had a late payment the last year, which was 34% more from the year prior. That's a little concerning. There's a lot of evidence consumers are being crunched, but that was one of the more concerning figures we've seen. And then this chart, this is the University of Michigan Consumer Sentiment Reading. It came in at 52.2 in April. That's down from 57 in March and 77.2 a year ago. In particular, tariffs affecting trade as well as inflation concerns were a couple of the biggest perceived risks moving forward. And also weaker labor market expectations. Year ahead inflation concerns moved down from 5% in March to 6.5% in April. But shortly after we saw these two figures, we saw April payroll growth top expectations. We saw part-time and full-time employment both move higher. Wage growth topped inflation. So overall, it was hard to find anything significantly worrying in those numbers. So moving away from consumer demand there, let's look at global demand. U.S. beef exports in last week's release were up 20% from the week prior and 8% higher than a year ago. Looking at exports to China. We've lost pretty much all of our export business to China through this tariff war. This leaves the door open to Australia to steal some of that business back. And the longer that beef trade is at a standstill with China, the harder it's going to flip the switch back on as it comes to the overall trade structure. So that is a concern. On the other hand, Australia can't compete with our quality of beef. And China has grown an appetite for it over the last few years. Australia may have some that is somewhat comparable as far as high quality white fat marbled beef, but they cannot compete with the volume that we produce over the long term. I think Australia had something like 1.5 million head of cattle on feed this first quarter this year, whereas the U.S. currently has around 11.5 million head on feed. So there is certainly reason for China to open back up its shores to us, since the alternative is limited and still not comparable in quality. With that said, Australia's grain-fed exports, they are up 41,000 metric tons, or about 36% for the first 4 months of this year. So China may be grabbing some of that. Looking at exports to South Korea, they've picked up some of the lost business the last few weeks from China that we've lost to China. Exports to Korea are up 2,877 metric tons year to date, about 4.22%. Looking at Japan, Japan picked up some of the slack. You can see here, I mean, that last week we had a huge drive higher. And a piece of that, I believe, is the yen. So if you look at the Japanese yen here, yeah, there it is. A lot of that may be the yen's rebounded about 9% since the first of the year, with much of that occurring in April. So maybe a short-term deal. We'll see what the yen does. But overall, if you look at the U.S. dollar, it has cheapened up significantly. It's dropped about 10% since the first of the year, which will be positive to our export market. U.S. beef exports, they're down 16,000 metric tons year to date, about 6.5%. Overall, Brazil and Australia, they're still flooding the global market with beef, with Brazil exporting 12% more than the first quarter of the year across the globe versus last year, and Australia exporting 14% more across the globe. Looking at U.S. beef imports, they were down 2% from the prior week. Compared to a year ago, they're 16% higher for that week. Year-to-date imports are up about 50,000 metric tons year-to-date, or about 9.5%. Again, U.S. imports from Australia, New Zealand, along with South American countries such as Brazil, Argentina, and Uruguay are all higher so far through this year. Now, the beef imports into the U.S., they're not necessarily a bad thing. The great majority of imported beef is 90s lean trim. We use that to mix with the fattier domestically produced 50s trim from fed cattle to make our ground beef. So with the amount of 50s trim we are producing, it is giving more value if it can be mixed with that 90s trim due to the demand for ground beef, opposed to it being sold separately, such as tallow. Looking at feeder cattle imports, the threat to close the Mexican border to feeder cattle into the U.S. Appears to be resolved now. The threat was mostly due to the U.S.'s disappointment in Mexico's responsibilities to uphold the quality of their controls and the fight against spread of New World screwworm into the U.S. Feeder cattle imports from Mexico, they're down 320,000 head year to date through 18 weeks. Looking at a chart, it looks like current protocols allow a maximum limit of about 20,000 head per week to pass through. Last year, that averaged about 27,500 head per week throughout the year. Now, to finish up here, herd expansion. There are some signals and growing incentives for herd expansion, for heifer retention. The latest monthly cattle on feed report for April showed the heifer percentage of cattle on feed as of April 1, the lowest since April of 2020, at 37.6%, and nearing the 20-year average of 36.8%. This suggests that we're beginning to see some heifer retention. Not until that number dips below 35% will herd expansion be well underway. The increasing premium of bred heifer prices to feeder heifer prices that has been observed over the last year in some regions, that's also provided a growing incentive to expand. Therefore, the market is signaling that we are in the early stages of a shift from contraction to expansion. And with the recent rains across the central and southern plains, improved summer grazing conditions increase the chances of heifer retention more. But this is a slow process. It has already been prolonged. Weather has to continue to cooperate. So if the market is now signaling a shift from contraction to expansion, that shift will be a period of a couple of years at least. Heifer kept this year. Its calf won't hit the market until 2027, 2028. So overall supply fundamentals don't look to be changing drastically anytime soon. At this point, it's a demand-driven market to keep us rolling higher, in my opinion. The market knows this, and there are signals out there that consumers are beginning to feel a crunch in their wallets. But as I said earlier, cattle prices are climbing the wall of concern.
Is this expansion on the heifer side, is that expected? Is it on schedule, would you say, or where?
I believe that was a little lower than expected. I don't think anybody had really seen on the radar much of a move lower. So as far as it being the lowest since 2020, I wouldn't say it was a shock, but it was bound to happen at some time. So not a big move. Again, that shift from contraction to expansion is so slow. I don't think we'll be seeing it break that barrier below 35% anytime soon, where typically we see expansion really start to take off.
Announcement today on a trade agreement with the UK. Any impact at all on the beef sector here in the US?
Not so much with the UK. We don't. They're not much of a trading partner on the beef side, so not too much of an impact on that side.
Very good. Final thoughts to leave us with today here, Trey?
You know, it is so great to see feeders break that $300 mark. It's going to be exciting the next few days. See what the future holds. But this market just is on fire. A pullback is due. We are approaching overbought levels here. But I mean, enjoy it while it lasts, I guess I'll say.
There we go. So Trey Freeman of Ever.Ag, thank you so much for joining us and for sharing your insight on this on the marketing side of the beef industry. We appreciate that.
Thanks, Sarah.
Likewise, we appreciate all of you joining in. A reminder, you can view Feedstuffs interviews in Feedstuffs 365 on thefeedstuffs.com. Until next time, for Feedstuffs, I'm Sarah Muirhead.